Here's something most beginners don't realize. Many altcoin projects fail or fade away, often leaving tokens nearly worthless. An altcoin is simply any cryptocurrency that isn't Bitcoin, and while Bitcoin is the first decentralized cryptocurrency, often seen as a potential store of value, most altcoins carry much higher risks. Projects can fall apart from technical bugs, poor management, lack of adoption, or even running out of funding, leaving investors holding assets with no real market. In this video, we'll strip away the hype and explain both the risks and opportunities across the crypto landscape. You'll leave with a clear framework for spotting risky projects, a simple checklist to evaluate altcoins, and one method to reduce emotional mistakes like FOMO or panic selling. And before you can apply those strategies, it's important to understand why crypto markets move so quickly in the first place. But first, this video is for informational purposes only and is not financial advice. I'm not a licensed financial advisor. You should do your own research and consult with a qualified professional before making any financial decisions. Hey, welcome to the Trading and Investing Hub. I'm Alex, and today we're talking about cryptocurrencies. Crypto stands out because it moves with an intensity and speed that few other markets can match. Prices can shift dramatically in short periods, and this volatility comes from the unique structure of the crypto ecosystem. To understand why, it helps to look at how it differs from traditional markets. In stocks, trading happens within a highly regulated framework. Government agencies monitor activity, exchanges install circuit breakers that pause trading during extreme moves, and central banks can step in with interventions when the broader system looks unstable. These safeguards act like speed limits. Crypto, on the other hand, runs without them. There are no circuit breakers, no central banks calming the waters, and no set of regulators coordinating responses during shocks. The result is a market where fluctuations that would take weeks in stocks can play out in hours or even minutes. The second factor is liquidity, which is a term that simply means how easily an asset can be bought or sold without changing its price. Stock markets are incredibly deep, with enormous pools of capital from pension funds, hedge funds, and institutions constantly providing buyers and sellers. That cushion absorbs a lot of activity with barely a ripple. In crypto, those pools are much thinner. If someone tries to sell a large amount of a mid-sized coin, there may not be enough buyers lined up on the other side. Prices then lurch to new levels as the market tries to rebalance supply and demand. This thin liquidity is one of the main reasons sudden double-digit swings feel routine in crypto. Another driver is the absence of a central authority ready to stabilize markets. Traditional financial systems often lean on central banks to inject liquidity or signal future policies, which can calm investors. Crypto has no such backstop. When governments do step in, it is often in the form of abrupt regulatory changes or restrictions. Those announcements can themselves create turbulence, since the market usually gets no gradual warning. A new rule, an exchange restriction, or a potential ban in one country is enough to ripple through global prices within minutes. News and sentiment play an outsized role as well. Stories picked up by media outlets, viral posts on social platforms, or speculation about upcoming regulations can all push prices without much warning. Since crypto trades 24/7 worldwide, these shifts get absorbed instantly. Where stock markets might digest news over time, crypto reacts in real time and often much more violently. Investor psychology adds another layer. Traders watching rapid moves can get caught in emotional cycles, piling in during surges or rushing to exit during drops. While this behavior exists in all markets, it is amplified in crypto because institutional players, who often bring steadier long-term strategies, still make up a smaller share of overall activity. This leaves a larger proportion of trading driven by short-term speculators, which magnifies both rallies and declines. To visualize it, think about a small fishing boat compared to a giant cruise ship. The cruise ship, like the stock market, is so massive that waves and storms take longer to shift its direction. The fishing boat, much like crypto, feels every swell bouncing rapidly with each change. Both react to the same motion, but one responds far more violently. Because crypto is less mature and less liquid than stock markets, expect faster moves and size positions accordingly. Crypto markets move faster, not because of any mystery, but because they operate without stabilizers, with thinner liquidity and under constant influence from news and investor emotions. That combination produces an environment where dramatic shifts are the norm rather than the exception. And once you recognize speed and volatility as the baseline, it becomes easier to notice the repeating patterns that sit on top of it. One of the most intriguing of these patterns centers on how money flows between Bitcoin and smaller coins, creating moments when those lesser-known projects suddenly take off. One of the most puzzling dynamics for new investors is the sudden rise of smaller coins all at once. This phenomenon is often called an altcoin season. It's not random, and it has a lot to do with how money and confidence flow through crypto markets. Altcoins, short for alternative coins, include every cryptocurrency that isn't Bitcoin. Some exist to make everyday payments faster and cheaper. Others experiment with different consensus methods like proof of stake, and many form the backbone of platforms powering decentralized finance or NFTs. This wide variety gives traders entire niches to explore beyond Bitcoin, and at times that diversity creates bursts where many of them climb together. Here's what often sets the stage. Most new money does not rush straight into unknown altcoins. It first flows through Bitcoin, the most widely recognized and broadly listed asset. Investors see it as the entry point and, compared to other coins, the lowest risk way into the space. After Bitcoin rises, people begin looking for higher returns. That's when capital rotates outward, spilling into altcoins in search of bigger percentage gains. A common beginner trap happens right here. Many see a coin priced at $1 or less and assume it has massive upside simply because it looks cheap. But a coin's per token price says very little. The real measure is market capitalization, which is the price multiplied by the circulating supply. For example, a coin priced at 50 cents but with billions of tokens circulating could already be valued in the billions. In plain English, don't judge value by the price tag of one coin. Look at its total market cap and the fundamentals behind the project first. Once investors start rotating out of Bitcoin, altcoins can move much faster because they're smaller markets. Picture Bitcoin as a large container. When it absorbs the first surge of demand and feels full, the overflow spills into rows of smaller cups, which are the altcoins. A relatively small amount of new money can lift their prices quickly, leading to those steep-looking charts beginners call altcoin season. History shows how powerful these rotations can be. During late 2017, Bitcoin captured global media coverage with a massive surge. Shortly after, Ethereum and Ripple soared even higher in percentage terms. Investors decided Bitcoin was too expensive and piled into the next options, assuming the profits had to continue somewhere else. Another cycle appeared in 2020 during the DeFi summer. Projects tied to decentralized finance captured attention with lending, borrowing, and yield strategies built entirely on blockchain networks. Those altcoins quickly multiplied in value as capital rotated into the new trend, only for much of that profit to evaporate when sentiment reversed. Psychology makes these moves even sharper. Investors frustrated by missing earlier gains chase after coins showing momentum. That fear of missing out pushes in more buyers, each surge attracting another wave. It becomes a feedback loop of excitement that can quickly burn out once the first signs of weakness surface. The difference is liquidity. Bitcoin has deeper markets and larger participants, so it tends to stabilize more easily. Altcoins with thinner order books can rise faster, but also collapse faster once the buying slows. The key point to understand is that altcoin seasons are not random eruptions. They're patterns of money rotation and trader psychology. Sometimes specific innovations, like DeFi in 2020 or NFTs in 2021, fuel the trend. And other times, it's just capital chasing the highest potential gains. But whatever the trigger, the drivers are the same: liquidity, sentiment, and the perception that Bitcoin has already made its move. Here's a quick rule. If you're chasing altcoins, check the market cap and the token's actual purpose before buying. That simple filter can stop you from buying into hype with no staying power. And while the upside in these seasons can look tempting, what matters just as much is recognizing when they may be ending. Because when money rushes out, altcoins often fall faster than they rose. Understanding what signals often appear before those drops is the next step. When a market looks unstoppable, that's often the moment it's most vulnerable. Spotting cracks before a crash isn't about predicting the future with perfect accuracy. It's about reading the signs of excess before they spiral into losses. Crypto rarely collapses without warning. More often, you'll notice signals: unsustainable price runs, growing speculation, and a gap between real demand and the hype fueling prices. Recognizing these patterns early can mean the difference between protecting gains and being caught in the fallout. One of the clearest signals is when charts start accelerating upward at an unnatural pace. This is called a parabolic move. Imagine a price trend that slowly climbs like a staircase, then suddenly tilts into what looks like a near vertical wall. That curve feels exciting in real time, but mathematically it can't continue. Once buyers start hesitating at higher levels, the speed of the climb works against itself. With fewer fresh buyers stepping in, all it takes is a small wave of selling to snap the parabola and send prices sliding fast. These sudden rises and sharp reversals have been part of nearly every crypto cycle to date. Excessive speculation is another warning sign. This shows up when traders pile heavily into short-term bets, each one expecting the rally to continue indefinitely. When too many traders move in the same direction, any pullback can quickly snowball. A small drop forces quick exits, putting more selling pressure on the market, and that pressure triggers even deeper moves. Instead of a gentle correction, you get amplified losses that feed on themselves. This dynamic doesn't require extreme leverage to play out. It's a structural risk in markets where speculation outruns real demand. Liquidity plays just as important a role. Liquidity, put simply, measures how easily you can buy or sell an asset without moving its price too much. In euphoric phases, it seems like liquidity is everywhere. Buyers are lined up, eager to get in. But at market tops, that depth dries out. Buyers aren't as willing to step up at record levels, while more sellers rush to take profits. Suddenly, every sell order cuts deeper into the price. This mismatch explains why crypto drops can feel like free falls. There are fewer willing buyers exactly when sellers become most desperate. Media and sentiment also magnify these cracks. If the majority of coverage praises endless upside and influencers flood social channels with confident predictions, that's often when retail traders, the everyday investors, step in most aggressively. Institutions and seasoned players, however, often treat those same moments as ideal opportunities to reduce exposure. This imbalance, retail entering late while larger investors are already selling, tends to accelerate declines once the narrative shifts. Rather than viewing these signs in isolation, it helps to connect them together. Parabolic charts, a surge of retail enthusiasm driven by media hype, and weaker liquidity at the top are a powerful combination. They indicate a market stretched thin, more reliant on excitement than fundamentals. When that happens, even minor bad news or a modest profit-taking wave can set off something much larger. Here's a practical rule of thumb. If you see prices turning parabolic, social platforms filled with certainty about never-ending gains and fewer real buyers at each new high, it's time to tighten your risk. Shrink your position sizes, lock in partial profits, or set stop-loss levels to protect your capital. The aim isn't to call the exact top, it's to recognize when the balance of risk versus reward stops favoring more exposure. These patterns are not one-off events, they recur across crypto history. Each rally eventually gives way to a correction once speculation outpaces real adoption. That rhythm is baked into how these markets grow and reset. Understanding these signals builds confidence, not just for reacting to crashes, but also for anticipating the broader structures that surround them. Because step back for a moment, crypto may feel chaotic on the surface, but when you zoom out, the same stages seem to repeat again and again. The real question is why those cycles keep occurring, and why events like Bitcoin halvings or altcoin seasons reappear with such consistency. Cycles in crypto markets are not random bursts of chaos. They follow repeating structures that influence how assets rise and fall. Among the clearest examples are Bitcoin's halving events and the way capital shifts between Bitcoin and altcoins. Understanding these rhythms doesn't just make history easier to read, it gives you a framework for setting expectations in the future. Let's start with the Bitcoin halving. This event happens automatically in Bitcoin's code roughly every 210,000 blocks, or about every 4 years. At each halving, the reward miners earn for adding transactions to the blockchain is cut in half. That means fewer new coins are created going forward. Because Bitcoin's total supply is capped at 21 million, each halving slows the pace at which the remaining coins enter circulation. In plain English, supply growth keeps shrinking, while demand has often stayed steady, or even increased. That shift in market balance has repeatedly set the stage for rallies. We have evidence from past cycles. After the first halving in 2012, Bitcoin's price climbed from single digits into the hundreds over the following year. The 2016 halving came before the surge that peaked in late 2017, when Bitcoin pushed into mainstream headlines for the first time. And the 2020 halving was followed by a run that took Bitcoin from under $10,000 to record highs above $60,000 within the next cycle. It's important to note the halving itself doesn't guarantee a rally. What it does is establish conditions, less supply entering the market while interest continues building, that have historically tilted the odds toward major moves. Another repeating pattern plays out through Bitcoin dominance. Bitcoin dominance is the percentage of the total crypto market capitalization accounted for by Bitcoin alone. When dominance rises, more of the crypto market's value is concentrated in Bitcoin relative to other coins. When dominance falls, it signals that capital is spilling over into altcoins instead. These shifts help explain the timing of so-called altcoin seasons. Here's how the cycle often unfolds. Bitcoin climbs first as new money flows into the most established asset. Once that momentum slows, traders searching for higher returns rotate into smaller coins. That rotation is what lowers Bitcoin dominance while raising altcoin prices. A clear example came in 2020, when confidence returned after the March crash. Bitcoin stabilized, and investors began pouring into decentralized finance projects built on Ethereum. The result was DeFi summer, with tokens from lending and trading platforms multiplying in value while Bitcoin's chart flattened out. These recurring waves aren't driven only by mechanics, they're shaped heavily by human psychology. Rising prices attract media attention, which brings in casual investors. Their buying pushes prices further, which creates new headlines that fuel yet another wave of interest. It becomes a feedback loop that drives cycles higher until enthusiasm runs ahead of fundamentals. When the mood flips, the same loop works in reverse. What's important to recognize is that volatility does not mean pure randomness. These repeating signals, coded halvings, shifts in dominance, and the accompanying swings in sentiment outline a framework. They won't tell you the exact day the market tops or bottoms, but they do give you conditions you can prepare around. Think of them the way you think about seasons. You don't know the precise timing of every storm, but you know summer brings heat and winter brings cold. Similarly, halvings typically compress supply, while falling dominance often precedes altcoin rallies. So how should you use this knowledge? Not by trying to predict exact numbers, but by adjusting your risk exposure. If a halving has just taken place, understand that history suggests conditions are shifting in a supportive direction for Bitcoin. If Bitcoin dominance begins sliding, know that money is flowing toward riskier plays and altcoin volatility will likely rise. The practical takeaway is simple. Use halvings and dominance trends to guide how much you risk and what assets you hold, not as crystal balls for exact tops and bottoms. Cycles help you understand the setting you're trading in, but navigating them still requires discipline. Market patterns can guide you, but avoiding costly mistakes depends on how you handle emotions like fear of missing out or panic when swings take hold. And that brings us to a critical discussion: the tools that keep FOMO and FUD from wrecking your strategy. Half of the real danger in crypto doesn't come from the technology. It comes from how people react under pressure. Two emotional forces dominate: FOMO, or fear of missing out, and FUD, or fear, uncertainty, and doubt. In plain English, FOMO is the rush to buy because you're afraid of missing profits, while FUD is the urge to sell because negative news makes you think disaster is coming. FOMO often leads to buying near local tops, while FUD pushes people to sell at temporary bottoms. Both reactions quietly erode returns, even when the larger market cycle might have rewarded patience. Picture this scenario. You read dozens of posts claiming a coin is about to explode, so you buy after a steep run-up. Days later, headlines about regulation hit, prices slip, and panic spreads. You sell into the dip, convinced worse is coming. You didn't follow a plan. You followed emotion twice, and both times locked in losses. That loop of chasing highs and selling lows is how many accounts shrink during volatile swings. The first way to protect yourself is sticking to the golden rule. Never invest more than you can comfortably afford to lose. This reduces emotional pressure immediately. If your rent, groceries, or student payments don't hinge on the portfolio's value, sudden drops won't feel like personal crises. A simple tip: decide on the portion of your income or savings you can truly put at risk without lifestyle consequences, then limit your trades to that pool only. A second safeguard is the stop loss order. A stop loss is just an automatic instruction. If a coin's price falls to a level you set, the system sells for you. Think of it as a seatbelt. It doesn't stop the crash entirely, but it limits the damage and gets you out before things spiral further. In crypto, where overnight drops of double digits aren't rare, stop losses are essential. A practical approach is to place them at points where you know your trade idea has failed. That way you exit on rules, not on impulse. Diversification gives another layer of protection. But here's the catch: not all diversification is equal. Many altcoins move in lockstep with Bitcoin, and loading up on 5 low-quality projects doesn't actually reduce risk. The safeguard only works if you carefully research projects, spreading your capital across assets with different fundamentals rather than just different names. A quick rule of thumb: never buy into an altcoin just because its token price looks cheap. Instead, check its market capitalization and real use case before including it in your mix. Beyond position sizing and stops, security is part of avoiding FUD as well. Nothing generates panic faster than losing coins to an exchange hack or wallet breach. The reminder here is simple. For long-term holdings, keep the bulk in cold storage, such as a hardware wallet, and avoid leaving large amounts on exchanges unless you're actively trading them. That habit alone turns a major external risk into a manageable one. All of these tools fit into the broader idea of having a trading plan. A plan sets your financial goals, outlines how much capital you risk per position, and defines entry and exit rules. It replaces mood-based choices with a structure you can return to when headlines or tweets try to sway you. Consider it the checklist approach. Just as pilots stick to procedure under stress, you follow your written plan rather than guessing in the heat of the moment. The difference is stark. Traders who define their exit levels in advance and act on them tend to cut losses early. Those who chase hype without rules often panic later, selling at much worse prices. The outcomes show that structure consistently limits downside, while emotion almost always magnifies it. Here's a practical exercise. Before your next trade, write down the maximum loss you're willing to take and the price where you'll exit if you're wrong. Commit to it. That single step anchors your decision-making in logic instead of fear or greed. When you build habits like these, sudden spikes and crashes no longer dictate your choices. And once discipline starts driving your actions, you begin to see volatility for what it truly is, a natural part of this market that you can prepare for instead of fear. Volatility is part of crypto, but it doesn't have to control you. The key is using systems and risk rules so you can survive the swings and let gains compound over time. What may look chaotic on the surface often follows patterns, and with the right mindset, you can navigate them with confidence. Here are 3 practical takeaways. First, understand cycles. Halvings and shifts in Bitcoin dominance create predictable environments to watch. Second, protect capital. Size positions carefully, set stop losses, and never risk more than you can afford to lose. Third, secure assets. Store long-term holdings in reputable wallets or cold storage for safety. Consistency and protection matter more than chasing headlines, and patience is what keeps you in the game long enough to benefit. If this breakdown helped, subscribe for more practical guides like this, and drop your biggest crypto question in the comments.